This is considered an intro webinar. So what I'm going to do is I'm going to cover the R&D credit in section 174 because they kind of go hand in hand now. I'll do a little comparison afterwards, and then I'll discuss some of the timing and legislative updates that are going on right now, and then we'll get to the Q&A. If we do not get to your question, if you've posted it, we will get with you after the presentation and make sure to provide you an answer. All right, so we're going to start with the R&D credit, and we're going to jump into the basics of it. Generally, the credit's officially called the credit for increasing research activities, and it's used against the tax liability on the income tax return. There is a payroll option for certain startups, but they have certain hoops that they have to go through in order to qualify for that. The basic qualification for the R&D credit is known as the four-part test. And the way the math works is you take the qualified research expenses, or QREs, that exceed a quote-unquote base amount, and you get a percentage of that excess as the credit. And we'll cover that a little more in depth. If you can't utilize a R&D credit against your income tax in a particular year, maybe you had a loss or something, that doesn't mean you can't use the credit at all. It can be carried back 1 year and forward up to 20 years. The other thing that happened back in, I believe it was 2016, is the R&D credit became permanent, meaning it didn't expire every 2 years, and you can now rely on it for financial planning, which is fantastic. With that being said, let's dive into the four-part test. And in order to qualify for the credit, there's a four-part test that has to be met. If you don't meet this test, you don't get to any of the other exceptions, exclusions, or anything else. It just doesn't qualify. So you have to have a business component being developed for a permitted purpose. The expenditures have to be able to be treated as specified research or experimental expenditures under 174. Substantially all of the activities must constitute a process of experimentation, and the process of experimentation must be intended to discover information that is technological in nature. So let's break this down a little bit. Business components, what are they? Products, processes, usually referring to a manufacturing process. Formulas, inventions, computer software, or techniques. Well, if you take a look at this, this basically boils down to products, processes, and computer software, because a formula, whereas if you are doing pure chemistry, you can qualify it in and of itself, but a formula is usually used for in a product or process. Inventions are almost always products, processes, or computer software. And techniques, I've actually gone in on several dictionaries to find out the definitional difference between a process and a technique, and I couldn't find any. That being said, if I have a problem with an IRS agent or anything saying, well, this wasn't a process, I'm going to argue that it was a technique and have them tell me why it's not. Permitted purpose. This is here, and it's kind of critical because it has to be for a new or improved functionality, performance, or quality or reliability. This is excluding things that are aesthetic, meaning we don't want to take a red bouncy ball and make it blue. We want to take a red bouncy ball and make it bounce higher, increasing the performance, something like that. And then the last one is that the business component must be for sale, lease, or license, or for use in the trade or business of the taxpayer. In 18 years, I've only had this exclude one project, so this doesn't come up very often. Now, elimination of uncertainty. And this is going to kind of tie into the section 174 portion of this webinar as well. So 174 basically says that the activities that are being done with the research have to be experimental or done in the experimental or laboratory sense and intended to discover information that would eliminate technical uncertainty regarding capability, methodology, or appropriate design. Please note you only need one of the three here. You don't need all three. However, if you can identify more than one, that just strengthens the argument that the research activity qualifies. Now, process of experimentation. Let me pause for just a second here. On the business component, the Form 6765, which is the research credit form for the tax return, is changed as of 2024. They are going to gather, the IRS is gathering much more information on it now. And starting next year, they're going to require a breakout of the top 50 business components by descending QRE value, or 80% of the qualified research expenses by business component, whichever hits first. Now, with the process of experimentation, there's been some case law that has pointed out that 80% or more of the activities must be a process of experimentation in order for this element to be met. And when we say process of experimentation, think of coming up with a hypothesis to solve an issue, one or more alternatives to solve that issue. Testing was performed or is performed in order to find out if those alternatives are good or not. And based on that testing, you have success, continued development, or failure. Failed projects are absolutely fantastic for the research credit. Technological in nature, the final part of the four-part test. This says that it must be intended to discover information that's technological in nature, meaning it's based on the hard sciences such as engineering, physics, chemistry, biology, life sciences, computer software, things like that. No soft sciences, and I like to always put out marketing, accounting, and psychology. Marketing is becoming a lot more scientific as the data-driven analysis there is done, but it is specifically excluded underneath the code and regulations. Now, that's the basic four-part test. And I will point out that, like all good areas of the Internal Revenue Code, there are nuances to it. There's exceptions and exclusions and a whole bunch of other stuff. Additionally, if the initial project does not qualify, meaning you're failing that process of experimentation or something like that, that's substantially all 80% test, then you can shrink back to the next smallest business component. For example, if we develop a ship in 23, we can qualify the ship. Then the next year we develop the same ship, meaning rinse and repeat, but we developed a new engine for it. In that instance, the ship's not going to qualify, but we can shrink back to the engine of the ship and qualify that development. Now, you can keep doing the shrink back to smaller business components of the overall project until you have something that meets it, or you shrink back to there's nothing else to shrink back to, in which case it doesn't qualify. Also note, internal use software, which is any software that is not for sale, lease, license, or otherwise marketed, has a bunch of additional tests that have to be either an exception, exclusion, or a test has to be met in order to qualify it for the credit. And when we get to 174, you're going to see it's a little different. But I wanted to point that out. Qualified research expenses, QREs. This is the driving factor for how much credit you're going to be able to get generally. And there's only 4 buckets of cost here: wages, contractors, supplies, and computer costs. And the wages are the percentage of time that the employee spends on the qualified business components multiplied against their W-2 Box 1 amounts, their taxable wages. And we're able to capture 3 different levels of research. We can do the direct researcher, meaning the person that is performing the research. We can get the direct support of that researcher. And for the example that the regulations gives is you have a chemist who's performing their beaker experiments, and then when they're done with the first experiment, they have somebody else clean the beakers. Well, the cleaner of the beakers is not doing research, but that is considered direct support because until those beakers are cleaned, the direct researcher cannot continue. Additionally, you can also get the direct supervisor of the researcher. This is not done by a org chart. This is done by who's the person that the researcher is going to for technical questions. And so on an org chart, it might be, well, here's my boss. But if that boss is the person that's just managing them from a personnel point of view and not from a technical point of view, you don't want to capture that person. Now, contractor QREs. Basically, if the contractor were an in-house employee and qualified, you can continue the evaluation for the contractor. If you ultimately qualify a contractor, however, you only get 65% of the amount as a QRE. And that's because it's a statutory cut. And basically, the government's pointing out that when a contractor invoices something, there's a built-in overhead amount on that. And so they're just taking that haircut right off. Now, there is a legal analysis on the agreement between the parties that has to be done because the government does not want to pay two parties for the same work. Now, please note the terms I'm about to go through are not lay terms. These are legal terms of art. There's case law behind each of them. But basically, the first prong is that whoever's claiming the credit has to have the economic risk, meaning if the project fails, who's left holding the check? And then the other prong is that they have to retain substantial rights in the research. Substantial rights sounds difficult to get, but it's not really. It's basically, do you have rights to exploit the research in other projects without having to pay anybody? You have to have both of these in order to qualify. So either somebody's going to have on economic risk, it's one or the other. Substantial rights can be borne by both parties. That's very possible. So either company A is going to have the credit because they have economic risk and substantial rights. Company B is going to have the credit because they have economic risk and substantial rights, or neither company is going to have the credit because it is very possible that one company will have the economic risk, but another company will have exclusive rights. And when that occurs, neither one gets to take the credit. Now, supply QREs, they can't be depreciable in nature, meaning useful life of more than 1 year in the hands of the taxpayer. So no computers or anything like that. It has to be intended to help resolve the technical uncertainty in the development. And it has to be used for research purposes, not general production. Now, please note that when we're looking at that, we're looking at the intent. It's perfectly okay that you have something that you intend for research purposes and it works so well that you're able to sell it. That's perfectly fine as long as you had that intent. Let's move on to the computer QREs. This one is kind of interesting because it's been around since the 80s, back when you would have to go and rent a computer from someone. And I've put the 3 requirements here where it has to be owned and operated by someone other than the taxpayer, located off the taxpayer's premises, and you can't be the primary user of the computer. For a long time, nobody touched this. But then we've gotten into the world of cloud computing now, and it's very often that developers will use like Amazon Web Services or something similar for developmental purposes. When you do that, you can capture that portion that's being used for developmental purposes towards the credit. Now, and then as I said, we said earlier, if you have questions as I go along, please put them in the Q&A, and we will go ahead and get to them at the end of the presentation. Um, the math for the credit. So, as I mentioned earlier, you take the current year qualified research expenses, you subtract out the base amount, and if there's an excess, keyword if, then you multiply by the credit percentage, and we'll discuss that in a moment, and you get the credit. Now, if there's no excess, there's no credit. So, what's the base amount? Essentially, there are two calculations, the regular credit and the alternative simplified credit. And within the regular credit, there's two methods to calculate the base period there. However, you don't get to choose between them. It's a factual analysis that determines which method you have to use. So when we're looking at the regular credit, there's actually a calculation where you take the historical QREs over a certain period divided by the gross receipts of that period, and then you index it against the average gross receipts of the prior 4 years. Now, that's calculation part one. Calculation part two is you take 50% of the current year QREs. Whichever is bigger of those, you take that amount as your base amount underneath the regular credit. Now, I mentioned that there's the 80s base and the startup base for the regular credit. Well, the 80s base, the historical period is 1984 to 1988. I'm middle-aged now, and that would put me at about ages 4 to 8 for gathering information using today's definition of what is qualified research, as well as getting the gross receipts from that time period. It can be very problematic to put together. If you can put it together, though, it can result in a much higher credit at times. And what you do is you take the excess, multiply it by 20% to get a gross credit. Now, the max credit that you can get underneath the regular credit is 10 cents on the dollar because of that second calculation on this slide. Essentially, if you have 1 million in QREs, your best case base amount is going to be 500,000, half of the current year QREs, multiplied by 20%, which gives you a $100,000 gross credit, 10 cents on the dollar. Now, the ASC, we don't have to worry about going back to historical periods or anything else like that. We go to the prior 3 years. We take the average of those 3 years QREs and multiply it by 50%. And that's going to be the base amount. If you don't have QREs in each of the 3 prior years, then you ignore that calculation, and the gross credit is a straight 6% of the current year QREs. If you do have the base amount, then the excess is multiplied by 14%. Now, please note that makes it sound like the ASC is much smaller than the regular credit. And typically it is. It'll typically result in 7 to 8.5 cents on the dollar, but it can become much larger or smaller depending upon that base amount. So it is possible to exceed that 10 cents on the dollar. Now, I will make note that the ASC method is much easier to get the information for and to calculate and sustain with the IRS, because the furthest you ever have to go back is 7 years. We're currently in 2025. So we can look at the 24 tax year plus 3 open tax years going back, which would be the earliest of which would be 2021. 2021's base period would be 2019 and 18. 18 to 25 is 7 years. So the worst case we're looking at is getting information from 7 years ago. And the IRS generally wants you to keep information for 7 years. So this should be something that's very doable. Now, underneath the regular credit, if you don't keep increasing your research, it becomes very problematic very quickly because you're going to not exceed that base amount and you'll have a zero credit. With the ASC method, it's very possible to exceed that base without increasing your research. So if we had 10 million in QREs in each of the base years, the average is 10 million, multiply by 50%, we have a 5 million base. If the current year QREs are 8 million, we've exceeded that base by $3 million, and that generates a $420,000 credit, even though our current year QREs are 2 million less than the 3 prior years. So a lot of times, even if you have the regular credit there, you want to evaluate the ASC because it may be giving you a better option because it's much more forgiving. Now, like I just said, you want to evaluate both credits at all times to make sure that you're getting the best amount with the least risk. And risk is something that does need to be talked about when you're looking at the historical base periods. It can also be a royal pain to go get that regular base period established, so it may not be worth the benefit amount in order to do it. But you should be evaluating it to see what's going on. Now, savings with the credit. Now, 7 to 10 cents on the dollar is the typical amount. That means for every million in QREs, which is very easy to hit, you're generating approximately a $70,000 to $100,000 credit per year. Even if you take that and multiply by half, you're getting 35 to 50,000 per year per 1 million in QREs. Well, this is significant tax savings because that's the direct tax credit for both small companies all the way up to multi-billion-dollar companies. Because with a small company, if you're getting 50K a year just on a million in QREs, that's a good return to help you. I mean, that's somebody's salary. If you're a multi-billion-dollar company, you're going to have a lot more than a million in QREs, and those credits are going to add up very quickly. Additionally, if you're willing to amend past years, that 35 to 50 turns into like 140 to 200. So it's a situation where you can go ahead and generate significant tax savings through this permanent tax credit. Now, I'm going to go ahead and flip over to Section 174 now. And we'll go through this a little slower because I assume a lot of you are familiar with the R&D credit, but 174 is a little different animal, and it came about in 2022, or at least the change to 174 did. Prior to 2022, you just deducted the research expenses underneath 174 like you did underneath 162, which is your ordinary reasonable expenses for the business. So it didn't matter if you had them as 174 or 162. Now you have to amortize all your 174 cost. And the amortization is not optional. It's a matter of if it is 174, you are required to amortize it. And it's broader than the R&D credit. A lot of people confuse the credit and 174 as the same thing. Well, if you remember on the 4-part test, only one part was that it had to be 174, and then you had 3 others you had to hop through. So the credit's more limiting. 174 is broader because it includes both direct costs as well as indirect costs and foreign and domestic costs. Domestic expenditures are amortized over 60 months, 5 years, and foreign costs over 15 years. I don't know if I have the correct number of months there on that one. I may have to check that. But both have a half-year convention in the first year, which means instead of getting on the domestic side 20% each year, you only get 10% in the first year. And this chart kind of shows you what's going on with a flow-through entity. So if you had specified in research and experimental expenditures of $1 million in the first year, then the timing difference looks like this. You get a $100,000 deduction in the first year and 900,000 stays in income. If you're at a max rate of 37%, that means you're paying taxes of $333,000 in that first year, increased taxes, as compared to what you would have been doing prior to the change to 174. For the next 4 years, you get a 20% deduction, and then you pick up the last 10% in the sixth year. And those deductions lower your taxes for the next 5 years, essentially. And at the end of the 6 years, or 60 months, 5 years, your tax difference is zero because it's a timing difference. The problem is you have the increased taxes at the front end, and that's where the pain is on 174. Now, with a C Corp, the pain isn't as much because the tax rate is only 21%. You can see that here in this chart, but it's still not pretty. If you have foreign costs, let's say you had $1 million in foreign cost, you only get 3.33% in that first year as a deduction, and the rest stays in income. And then you're only picking up 6 1/3 for the rest of the years until the last year. This means it takes a lot longer to recoup those amounts back, according to the timing difference. This is also especially noteworthy because a lot of the legislation that I've seen proposed to go ahead and fix 174 talks about fixing the domestic amortization, but leaves in the foreign amortization. Now, with a multi-year situation, I'm going to throw this up. If you had started amortizing at 22 and you had consistent R&D or R&E, I should say, for 174 of each year of $1 million, then you're going to have increased taxes over those first 6 years of $925,000. This is terrible. Now, after year 6, there's no income difference because you've caught up with the rolling amortization and your tax difference is nothing, provided that your SREs are staying constant. Now, in the real world, most companies continue, if they're growing, continue increasing their R&E activities, which means that this isn't even true. This is going to be even worse than this situation. For C Corps, it's 525,000 over the first 6 years. Still painful. But the one thing I need to drive home is 174 is not optional. It is required by law. Even though it's a timing difference, that front loading of taxes is very painful. So what you want to do is you want to optimize 174 in relation to the R&D credit if you qualify for the credit, because remember, there's 3 additional hoops. And even if you've already filed 174, those amounts may not be optimized. And if you can't claim the credit, there is actually, you can work to reduce the 174 number even further by being a little bit more aggressive while staying within reason underneath the law. Now, one thing I want to point out before we move on to what an SRE is here's that same chart with the flow-through endies, but I've included an estimated R&D credit based upon the numbers, and you're going to see that that credit each year is knocking off 85,000 off your tax liability. So that first year with that front load of 333,000 becomes 248. After the 6 years, that 925,000, we're actually subtracting out over $500,000, which means you're only being hit by 415,000. So the main point here is if you have 174 activities, you need to be evaluating the R&D credit to try to save your tax liability and keep it as low as possible. Okay, so let's dive into SREs for a minute. What is an SRE expenditure? The code says research or experimental expenditures which are paid or incurred by the taxpayer in connection with the taxpayer's trade or business are SREs. Well, that's kind of circular and doesn't really help much. There are a few things to take away from this, though. In connection with, which is underneath Section 174, is broader than in carrying on, which is what the definition is underneath 41. So even though we have those three additional hoops for the 441 credit, it's even more narrow because of that in carrying on definition. So we have to include direct and indirect costs that reasonably relate to the research and experimental activities. Now, 174 calls out software development costs as SRE expenditures. However, that's all that it said. It didn't define what software development was. And with the software development, we have a little guidance from the Treasury Department, but it's not very good. So, direct cost, think R&D personnel, contractors, materials, etc. Very similar to the R&D credit. Contractors, there is no haircut on them, though. You're including 100% of the amount. For wages, you're using the gross compensation, not the taxable compensation. Indirect costs include things like rent, utilities, other overhead costs that are reasonably related to the direct cost. However, if you have, let's say, 50% of your personnel are performing R&D activities, you don't take all of your rent and utilities and everything else. You could make a ratio of some sort to allocate those and get a 50% of them or something like that in this particular instance. So when you look at the indirect cost, there's an art to it. Now, there are two notices on the substantive side that set out to define what SRE expenditures are, and I put them up here. They do an okay job. Some things are very well defined. Software development and contract research are not. As a matter of fact, notice 2023-63 was so poorly defining what contract research was that they came out with 2024-12 after just a few months and tried to clarify it further. It just muddied the waters even more. It's not very good. That, however, gives us room for working within the framework that they provided, and there's a lot of room for optimization there because you can work to define what is reasonable. Now, the Treasury Department is working to define or refine the definition of what an SRE expenditure is with the proposed regulations that should be out later this year. Those proposed regulations were initially supposed to be out last summer, and then they said the Q3, then Q4, then they said Q1, which ends in 4 days. And we have the new administration in, so I don't know when they're going to come out. They'll probably come out at some time that is not very useful. But let's move on to optimization here. So, optimization. What do we do here? We get the taxpayer's financials. We determine the direct cost, usually in conjunction with an R&D tax credit study, because the R&D tax credit is going to identify those wages, contractors, supplies, and computer costs that are directly involved with the R&D activities. Then you have to go through and determine all the indirect cost buckets and then figure out how to allocate those amounts. And the allocation is really where our expertise comes through, because the notices provide several different suggestions on possible methods, but they say any reasonable method is acceptable as long as it is reasonable underneath the facts and circumstances of the taxpayer. So the name of the game here is compliance with optimization. You don't want to just say, oh, here everything's 174 and have this really big 174 number that takes all that front loading of your tax liability and drives you bonkers because you have to come up with this ridiculous tax bill. So if you're able to lower 174 without gutting the R&D credit, because the 174 is a timing difference, and you don't ever want to take a try to optimize or maximize a timing difference at the expense of a permanent tax credit, because tax credits are stronger. So there's a balancing act here that needs to be done. Now, let's do a little bit of timing and legislative outlook for a moment. And the timing here for 22 and 23, there is a Rev Proc that came out in January, I believe, that said we can catch up a taxpayer on their 24 return for the 22 and 23 amounts of 174. This prevents you from having to it's basically designed to get you in compliance, because that's what Treasury and IRS want to happen. They don't want people skipping this. But the change to 174 amortization is considered a change in accounting method. So you have to go through and do it on a timely filed return. Now, if you over amortized in a past year, which I have seen, then that extra amount will be an extra deduction on the 24 return. I had one client that had worked with a provider that was very aggressive on 174 and said, oh, here, this is all 174, and put down $2 million. Well, when we went through and did the analysis, we determined that they were a service provider for most of their contracts and did not have the necessary prawns to trigger 174. And we ended up determining that in 23, they only were supposed to put down like $150,000. Well, all that extra amount went on to the next year's return and was able to be deducted. Now, more commonly, what we're looking at is an under amortized situation, or somebody that hasn't amortized at all. Then those amounts are going to be included in income. However, the income exclusion will be spread out, or the income inclusion, excuse me, not exclusion, will be spread out over 4 years with a 481A adjustment, not all at once. So if you had, let's say you pulled in $1 million in income into the 24 return that you should have recognized on past years, you don't take $1 million in income on 24, you take 250,000, and you take 250 on 25, 26, and 27. At the same time, if you remember the amortization chart, you're also getting those 20% deductions from the past years. So it's a 250,000 increase, but a $200,000 decrease from that amortized amount for 24, 5, 6, and 7. So you're only increasing your income by 50,000 in each of those 4 years for domestic costs. This makes it much better and is an incentive to go ahead and get things in compliance. Now, both parties of Congress want to fix 174 and return to immediate expensing, at least for domestic expenditures. The problem is they keep wanting to add other pork, or here, we'll give you this, but we want something in return, even though both sides want to fix 174. The latest legislation was the American Innovation and R&D Competitiveness Act of 2025 that was introduced on March 10th. And it actually said, we're going to go back and eliminate 174 from 22 forward. It had a retroactive provision. I think that retroactive provision is actually going to make it too costly to pass, because the government's already dealing with a lot of cost on some of the bills and such, and the balancing with the Reconciliation Act, which will probably absorb this bill. I don't see it passing in its current form. I could see a form where they eliminate the amortization on a prospective basis, but I don't see the retroactive happening. I do also see that 174 is in play for 22, 3, and 4. We might be able to get rid of it for the 25 tax year. The good news is They proposed the bill, and it had 71 co-sponsors in the House. So that's a good sign that Congress wants to get this fixed. Now, I'm going to talk about some audit issues briefly, because there are taxpayers that have not done 174 or have not complied with the notices. And note that the notices are not law, they're just guidance, but they're really strong guidance of what the IRS is going to be doing. And if you haven't done 174, you're just flat out not in compliance. That's a high risk move, because there is a research issues campaign going on, primarily for the credit, but they did add in the modern 174 to it. So if they audit you, they're going to look at 174 as well. And if they determine that you were under amortized, there is no 4-year spread. They're just going to put all that extra income in that year. That's going to increase your tax. You're going to have interest from that year forward, because you didn't pay all your taxes. And because these amounts can be so large, I wouldn't be surprised if they tried to assess penalties. Now, all of that's able to be fought in audit if it happens, but the better thing is to get in compliance now, not when you get caught. A little comparison between R&D credits and 174 is you've only got the 4 buckets of cost underneath Section 41 for R&D credits. For 174, it's anything reasonably related to the direct R&E efforts. So it includes those direct costs as well as the indirect, as well as patent costs and things like that. Section 41 as a tax credit is completely optional. It has a 4-part test for qualification. There's additional exceptions and exclusions you have to watch out for. And you can go after the 4 prior years, or 3 prior years plus the current year, for a total of 4 years. Now, 174 is required. It is not optional. It has a broader definition. The exceptions and exclusions within the notices can actually help the taxpayer, and you can't amend for 174. It has to be done on that change in accounting method within the 24 return. And we'll cover that a little bit more in just a moment. Now, the final thing is credits directly offset the tax liability, either in the form of initial tax liability in your current year or a refund check from a past year. The benefits of a 174 study is getting in compliance with the law, avoiding risk, and potentially lowering your 174 amount if you've already done it. Now, timing for 2024 returns is critical. If you have not filed, please extend. You don't actually have to, let me rephrase that. Put the extension paperwork on it, and then I don't care when you file, because we can put in a superseded return that replaces the original as long as the return was extended. And that gives us the time to get an analysis done for both the R&D credits and 174. And it gives you time to keep an eye out on the congressional action to see if there's a fix made sometime before the extension period is up. If you've already filed your 24 return without an extension, let us know. We can talk about options and we can figure things from there. Now, that